Okay, so very good morning to you, to all of you. The topic which we shall discuss today, maybe we discussed a bit more than this topic, but my key purpose of today's meeting is to discuss a very important topic in the field of finance called financial leverage. Finance, you know very well what is finance. Finance is basically where money comes from. And the money comes from basically a debt and equity. Debt, the lenders, the outsiders, they are only giving resources to the financial resources to the company, and the company pays them a certain fixed rate of interest. So there is an arm's length distance between the company and the debt holders. Debt holders can be the individuals, like I can buy a company's debt, like I can buy a company's shares. I can also buy a company's debt. And that debt is called CP, commercial papers or corporate papers. Yeah, like I can buy the treasury papers or the treasury bills. So yeah. And the equity, you know, that the shares. So basically, when I mention the word financial, it underscores the financial resourcing of the company, which primarily come from debt and equity. There's a hybrid funding called preferred stock, which has some characteristics of debt and some of equity, but that's very, very, very small proportion. If you see this word controlling shareholders and the non-controlling shareholders, this word you can often see in the income statement. So the controlling shareholders are the normal shareholders. We can call them common equity or the ordinary shares. But then we also have a phrase called non-controlling shareholders. Non-controlling shareholders are those shareholders of a company who have no voting rights. They surrender to have the voting rights. But in turn, what they get is basically the extra dividend, something extra, something fixed, like debt holders get something extra and fixed. Okay, so this is how we differentiate between these different kind of financing. Leverage would have different connotation. If you use the word leverage in non-financial context, I would say that we can say that, hey, you have great location, leverage it, make use of it. But in the financial context, the leverage basically means that the proportion of debt. So we use a phrase that the company is more levered when the company has more debt. And then we say that company is less levered when company has less debt. And if a company has no debt at all, we call it unlevered company. All right, so as I said that the leverage word is used in the context of debt. Some companies are hugely indebted, I would say. I would say that the financial sector is hugely in debt. As a matter of fact, we have a slide here. Well, why can't I show it to you? There is a slide here. You can see that. The internet sector, the IT sector basically, or the software or the heavy construction, they are less levered. Semiconductors, e-commerce are less levered. But if you go down, you find that the financial services, banks, automobiles, electric, utility, home building, paper, hotel, trucking, cable, natural gas, advertising, these are heavily levered sectors or industries in the US. And there is a red line, which is the average US company. And then you can see that there are some companies which are less than average. For example, metals and mining is less debted, drugs are less, medical suppliers, computer peripherals, and internet. But the financial services, very rightly so, the financial services are based on debt, basically. So why not they will be? So there's a reasoning why some companies and some industries are more levered. So I can say that financial services are the most levered industry and the internet is the least levered industry in the US. Okay, so that is the meaning of word levered. Yeah, make sense? Okay, now we go further to our main topic, which is the financial leverage. So here we want to study that how in the financial leverage, basically we are trying to study that how the leverage, that is a debt, and the company's risk, market risk, measured by beta, how they are correlated. So the one variable is that your leverage is increasing. So I can say that the debt to equity ratio is going up. Does debt to equity ratio, that is leverage, leading to or pushing the company more towards the systematic risk? So basically, in the financial leverage, we try to study what is the relationship between debt to equity, that is a leverage, and beta, the systematic risk. So we want to, because we have different way of thinking. Some people say that if a company is more in debt, it's good. It's good, which means the company might have less exposure to the market risk. But some people say, or some scholars, researchers are of the opinion, or even the corporate leaders, CFO, CEOs, they are holding this strong opinion that more you borrow, that is, more the company is levered, more would be the risk exposure, that is the beta. That is the way of thinking, okay? So I repeat, financial word comes from this phrase, the finance, which is basically debt and equity. Leverage is what is the status or what is the proportion of debt in the total financing. And the reason we do financial leverage is to assess that is that debt and equity and beta. So debt equity represents leverage and beta represents the systematic risk. So is there any relationship between the company's leverage and its systematic risk? That's exactly the main idea of financial leverage. When we discuss about the financial leverage, it's very important that we also have some discussion about the good and the bad things about debt. There's one school of thought who says that debt is cheaper. It's cheaper, it's less costly. Those people, those students who have studied accounting or are studying accounting, they would see, if you see the income statement of a company, and you will find that you pay the interest expenses before you pay the corporate tax to the taxman. In other words, the interest is tax exempted. But then we have at the end profit after tax, or the results after tax, or the earnings after tax, or the income after tax. So that is the net profit basically. The net profit is that share of the company's cash flows that goes to the shareholders. And I'm sure you know that net profit is calculated after the company has paid corporate tax. In other words, the cash flow which shareholders of the company get or after the tax is paid, it means the burden of tax is on cash flows going to the shareholders. But the cash flows that goes to the debt holders, that is interest expenses, that is finance cost or the finance expenses, these are tax exempted because that money goes to the debt holders before the company pays the corporate tax. So this school of thought says that, you know what, debt is cheaper because you don't have to pay any tax on it, okay? This is one good thing about debt, but at the same time, one bad thing about debt is that if you keep borrowing to avoid paying tax, then the problem is that the financial distress cost increases. By financial distress cost, I mean the probability of the company becoming bankrupt. Try to understand. When you have more equity than debt, percentage-wise, you have huge amount of equity and debt is less. The performance pressure on the company management is less. You know why? Because about equity, you don't have to give it back to the shareholders. The fact that the shareholders buy your equity, they are prepared to take risk. So even if you don't give their money back or they don't get any dividends, it's their problem. It's not the company's obligation. But if you just do the reverse, so if the company is 70% equity and 30% debt, okay, the company feels no pressure to pay dividends or return the principal amount back to the shareholders. But now see the situation. Now you don't have 70% equity and 30% debt. Now you have 70% debt and 30% equity. There would be a lot of pressure on the cash flows of the company. You know why? Because for debt, you not only have to give interest on the debt payments, but you also have to return the money you borrowed from the lenders. If you don't give the money back, if you don't pay them interest, you can be in trouble. So there is a more pressure on the cash flows of the company, which go up. So that makes unnecessary pressure. So if you are borrowing more, thinking that debt is cheaper, then you can put the existence of the company at risk. Because a couple of bad years, because of any XYZ reasons, and your cash flows get crippled, okay, you will not be able to pay interest, let alone paying the principal amount you borrowed, and then the company would be in a severe crisis. Many companies who were doing great job until 2 months ago, for example, the airline companies, look, the aircrafts are grounded, doing nothing now. So if a company has purchased a very problematic thing, even though the interest expenses are still tax exempted. But see, you are saving a bit of money of the tax exempted amount, but at the same time, you can put the company at a huge stake, at a huge risk. So that is why there are some good things and the bad things about debt. One more good thing which I feel about debt is that it makes managers responsible. We use a phrase in the business world called managerial slack. Managerial slack means what makes managers lazy, what makes them complacent, what makes them have a laid-back attitude. And there is a strong view in the field of finance that if a company is having less debt and more equity, which means the company is less levered, the company top managers feels less pressure to return money to its investors, and then they become lazy. There is a slack. On the contrary, if you have more debt proportionately, the company is more levered, then the company managers not only have to give the interest to the debt holders, but also return their principal amount as well. So in that case, the managerial slack can be less. But when I see these things, good things and bad things about debt and equity, I find that everything is good about debt. But when I see the financial distress cost, that suddenly there is so much pressure on the company to return, to generate cash flows, to give back the interest and the installment of debt. That scares me. And I will show you what scares me with one example as we progress further. So this is something, a background of financial leverage, what it is. It's comprised of two words. I explain the meaning of the individual words and what is meant by when I combine these two words, what message it gives. The main message it gives is that we want to see the relationship between the company's leverage and its beta systematic risk. That's what we try to do. But that's not everything. This is the little bit of background of financial leverage. A few things, theoretical things about financial leverage, I will tell you after we have some discussion. So, right. One thing which I want to very clearly tell you about the purpose of calculating levered or unlevered beta is that, now, are you clear about the phrase? I hope you're clear about the word levered and unlevered. If a company borrows, it's a levered company. It doesn't say how much you borrow. As long as you borrow, you are a levered company. You can be more levered. You can be moderately levered. You can be less levered. For example, when you see that, I think it's important that I discuss this thing with you again. If you look at this slide, you can see that the financial sector is the most levered industry in the US. You can see debt to value ratio. So what's the proportion of debt to the company's value? So for example, financial sector is almost 80% or a little less than 80%. And then if you look at the internet, it's less levered, which is about maybe 10%, 5%, yeah? But I will not call it unlevered. More levered, less levered. To me, a company is unlevered when it has no debt at all, with zero debt. When a company is zero debt, then we call it unlevered company. And the purpose. And one thing I want to tell you about this financial leverage or the levered beta or unlevered beta is that when you calculate beta, I'm sure you have done calculation of beta. In your task 2, 3, 4, there's plenty of opportunities when you will calculate beta or you might have calculated beta. That beta, which you calculate, is based on the company's stock returns. And the companies normally have debt. They can be more levered or less levered, it's a different question, but they have some fraction of leverage. There's hardly any company with zero debt. The only example I know is Microsoft around 2007, 8, when it has zero debt. No current debt, no non-current debt. But otherwise, I don't remember any example if I've seen with my own eyes with zero debt. So the point I'm trying to make is that the beta that you will calculate for a company or group of companies will be levered beta, because the companies which you choose in your portfolio, they would be having some debt. So the beta which you calculate will be called levered beta, or one more name for the levered beta we have is called equity beta. So the equity beta, which of course you calculate beta based on the equity price. And levered, because all the companies whose beta you're calculating, they have some fraction of debt. So they have levered beta, equity beta and levered beta. But here the story is very interesting. A company's CFO knows that the company's levered beta is 0.75 or 0.80, whatever. It might ask himself or herself a question. Hey, I paraphrase, I put quote unquotes. Hey, what would be my beta if I don't have any debt at all? And then he reminds himself or herself, but I have debt. I have debt. And the beta which I calculate based on this debt is levered beta or equity beta. But what if I assume? I mean, sometime in finance, we use this situation called scenario analysis or situation analysis, or we call it what if analysis. What if no debt? And all the money which is debt is basically equity. How much risk exposure I would get? In such what if analysis, in such hypothetical analysis, a situation, the CFO is pointing out unlevered beta. So you want to see the unlevered beta. Every company wants to see that how my beta would look like if I don't have any debt at all. So unlevered beta is based on your fantasy, in your dreams. If I have debt, based on debt, I can calculate debt affects my stock price. From stock price, I calculate stock return. From stock return, I calculate my beta, and that beta is called equity beta or levered beta. What if I don't have any debt at all? How my beta would look like? And that beta, which your dream beta or your thinking in your imagination, is called unlevered beta. And you can see here that is called unlevered beta, or one more name we have for unlevered beta is called, I didn't want to put the bracket, but I can write here, unlevered beta is also called asset beta. This is one more name. So please be careful. Equity beta and levered beta are same. And similarly, unlevered beta and asset beta are same. And the difference between levered and unlevered beta is that levered beta is a reality. And unlevered beta is based on your fantasy that, hey, what if I don't have any debt? Levered beta is real because the companies borrow. And the unlevered beta is based on the fantasy that, hey, what if I don't have any debt? How my beta would look like? That is the only difference between beta levered and beta unlevered. And the process is very simple. If you want to find unlevered beta, you just have to divide the levered beta with the bracket 1 plus 1 minus corporate tax rate times D to E ratio. Corporate tax rate, you know what is corporate tax rate? The corporate tax rate is the rate which you pay. I'll explain it with an example. And then debt to equity ratio, you know that this is the ratio of your leverage. If debt to equity ratio is going up, it means that the company is getting more levered. And if D to E ratio is going down, it means the company is getting less levered. Now it's a time that I should show you one example. And that example is in your, I can share my screen with you so that you can see what I'm doing. If you see the study material, there is a spreadsheet, and there's a spreadsheet called levered, unlevered beta, Microsoft. Let's click it. So we have levered, unlevered beta of Microsoft. All right, now I want to show you how we calculate it. I have a time period. I think this spreadsheet I made a couple of years ago. 2015 is the starting year, 26th of May. And you can see that the data is going all the way to so basically 23rd of May, 2018. 18, 17, 16. I start from 18. Okay, all right. So start from 2018. So the data is opposite. So it's like a, the oldest to the newest year. So this way. So be careful that when you calculate the stock return. So the data is in the ascending order. Ascending means from the older time to the newer time. But in some websites, when you download the data, it's from the newer to the older. Like for example, if you get the data from NASDAQ, OMX Helsinki, then it's from the new date. The current data comes first, and then the older and older and the older. And same way, if you download data from investing.com, it's always like this. But if you get the data from Yahoo Finance, then it looks like this. That you have the older period first, and the most current period is at the bottom. Anyways, so this is the stock price of Microsoft. This is the NASDAQ index. And this is how we calculate the stock return. So you can see that 27th of May, price minus 26th of May, divide by 26th of May. So the formula remains same, but you just have to modify your way of thinking. And then we have the stock return of Microsoft. And then the same way, we have the NASDAQ return, which means the current value of the index minus the previous value of the index, divide by the previous value of the index. And don't forget to put the brackets. It would be a horrible mistake if you don't put the brackets on both terms when you put this minus sign. Anyways, so this is a beta, slope of the company's return upon the index return. And you can see that the maximum observation we have are 757. And that proves my point that normally there are 250 working days in a year in the stock market, and not exactly 250, but you can make a guess that if there are 758, 59, 60 observations, you can see that hey, it's about 3 years. So 250 approximately. And we find that the beta of Microsoft is 1.15. It's quite big actually. And I'm not surprised because normally the growth companies, the IT companies, their beta is quite high because their cash flow can go up and down very fast. So there's a more systematic risk, more market risk. Some comments here. This beta, which I calculated, is called beta equity or levered beta. As I said, that beta equity and levered beta are same. And this is 1.15. This company is hazardous for those investors who have very small heart. Basically, those investors who are scared of taking risks, based on this data, they should not invest in Microsoft. But those investors who are risk lovers, they are ready to face the losses. This is a fantastic choice for those companies, those kind of investors. Basically, 1.15 shows that there are too many decimals, so let's have 2 decimals. Here too, there are too many decimals. So basically, 1.15 shows that if the average index, NASDAQ index, goes up, the value goes up by 1%, the Microsoft stock return will go up by 1.15%, 0.15% extra than the average, which is quite big. But at the same time, if the whole index return goes down by 1%, the Microsoft stock return will go down by 1.15%. It means that the company is 15% extra risky. So if I 1.15, if I minus 1, the company is 15% extra risky than rest of the index or the rest of the market. And now the CFO of Microsoft, this is, first of all, 1.15 is a reality. This is a reality. Equity beta, levered beta is a reality. And now the CFO thinks, hey, what if we didn't have any debt, no debt at all? How our beta would look like? As I said, that I can say on my own experience that when I was doing this company's analysis in 2007 or 8, I don't remember exactly, but I think 2007, the company has 0 debt, no short-term debt, no long-term debt. In that case, there's no difference between levered beta and unlevered beta because there's no debt. But the fact that now Microsoft is very high, is a highly levered company, a lot of debt Microsoft has. Now, with debt, beta is 1.15. The levered beta is 1.15. The equity beta is 1.15. The CFO of Microsoft is asking a question to himself, hey, what if I have no debt? How would my beta look like? Let's do so he's just playing with the numbers. And then he goes to his income statement and find out that profit before tax is some $23,149 million. And then the tax which company pays is 1945. Okay. And then from here, this is very important. This is called effective tax rate. Effective tax rate is that tax rate which the company in question is paying. Microsoft is US-based company. If just Google a corporate tax rate in the US, not that tax rate, not that tax rate. The tax rate which Microsoft is actually paying, it is paying, that is called effective corporate tax. And how do you find it? You divide the tax which company pays, the corporate tax which company pays, divide by the profit before tax. Profit before tax, or the earnings before tax, or the income before tax, or the results before tax, or the gross profit, these are the same things. So when you divide the corporate tax which company is paying by the profit before tax, you exactly know what percentage the tax Microsoft is paying. So if I convert it to for example, percentages, it comes out to be 8.40%. The company. I don't know what is the headline rate if you Google corporate tax rate in the US, but that's not even needed. We want to see what percentage of tax the company in question is paying. And then we find that the debt of Microsoft is, look at that, debt is more than equity. It's a highly levered company. So debt is some $86,194 million. And equity's book value is 72,394 million American dollars. And then we calculate debt to equity ratio, debt to equity ratio. Okay, and that's what we need. If I also slightly modify it to 2 decimal places, so that's what we get, 1.19. And then the most important thing is here, the unlevered beta or asset beta. And how do we get it? We apply the formula that we used in the slide. Levered beta divided by the full bracket, 1 plus 1 minus corporate tax rate, times debt to equity ratio, and the full brackets closed. And that's where we are. F3 is your beta, levered beta, divided by bracket starts, 1 plus, again, small bracket, 1 minus J9. J9 is your tax rate, times J12. J12 is your debt to equity ratio, and the bracket closes. It comes out to be 0.55. This is such a big revolution. It says that the company, if this company was having all equity and no debt, its beta would have been 0.55. Look at that. Look at such a big difference is made by debt. With debt, the company's systematic risk is 1.15. It's quite a risky company, but without debt, the company's beta is 0.55, which means basically very, very less risky. This company, I use the word that this company is not good for the small-hearted, weak-hearted person. And now this company is more for people who are risk averse, who don't like risk. Look at the transition. Almost 2.5 times more risk, or at least 2 times more risk when the company is having leverage. When the company is unlevered, it's 0.55. Such a big difference is made by this debt component. But again, I tell you something, that the unlevered beta is conceptual, theoretical, notional. It's like some kind of imaginary situation that, hey, what if we don't have debt? Then the beta would look like this much. But the reality is that we have debt. So beta, the real beta is this. But it's nice to, I mean, this can be a fantastic thesis topic that you are calculating. You take a sample of Finnish companies, and you are calculating their levered beta based on different years, multiple years rather, and then you are comparing. And in Finland, first of all, and then you are calculating the unlevered beta and see if this difference is significant. In Finland, I expect the big gap between levered beta and unlevered beta because Finland is a very high tax country. Do you get my point? The gap between this beta and this beta would be less in a country where taxes are comparatively lesser. But I'm expecting more difference between levered and unlevered beta if tax rate is huge. And look, Microsoft paid only 8.4% tax, and see the difference. So with 8.4% difference, the jump is so big. Imagine if tax rate is 55%. What difference will it make? It'll be massive. So it's nice to know that sometimes we use this kind of in finance or in other fields also. We do this what if analysis that, hey, what if this is the situation, how the companies would look like? Maybe the companies are not even aware of the fact that if they have no debt, how they would be facing the market risk. Market risk is a big risk, believe me. I mean, what is happening nowadays? If Finnair or any company for that matter is losing money nowadays, is it because of the fault of the company? No, the market is adverse. And the market is not just adverse because of the financial reasons. It could be because of any disease. It could be because of any natural catastrophe. It could be because of some war. It could be because of any XYZ reason. It could be even because of change in the government or the government's policies. So these are strong factors which can expose you or expose the company to the market risk. And you can see here that the market risk falls so drastically with without debt, and with debt it's so big. So if somebody is interested, I would be very happy to supervise you. You can think about, or you can make a comparison. You can take two countries and you can take a sample of one country's company and the second country's company, and one could be very high tax rate country. The other could be a small tax rate country. You know, we know that in some countries the tax rate is not much. And then you see that, does the difference between levered and unlevered beta is still substantial, or does it say something else? But anyways, I let you go through this spreadsheet. You can access it. It's in Optima. Go through it. But otherwise, if you have any questions or points, please ask me. Okay, so now you know that what are the steps to calculate the unlevered beta. To calculate the unlevered beta, you have to first follow the same process that you follow to calculate the normal beta. The normal beta is the equity beta or the levered beta. But then you need some extra information. The extra information is that you can see here that, let me share it. Yeah, okay. The extra information is that you need to go to the company whose unlevered beta you're interested to calculate. Look at the profit before tax, and then you find the tax rate, the tax which company is paying, and then based on this, you can calculate the the effective corporate tax rate. Don't use the Googled tax rate, which is called headline tax rate. No, don't use. Find the tax rate which a company in question is exposed to. Then see the company's total debt, the equity, and then find the ratio. And when you have all these components, you have the beta already, and you have some additional numbers. And when you have them, just put it together and use this formula. And this formula is based on this formula, which is here, which is this, the levered beta divided by everything. So, and after this, you are able to calculate the unlevered beta, and then you can make a comment. And this is the calculation. The interpretation is that there is a significant gap between levered and unlevered beta, and the inference I can draw is that if a company is debt, the leverage is making a huge difference between the company's high riskiness and low riskiness, and this is because of the debt to equity ratio. So in other words, if this company, Microsoft, wants to reduce its exposure to the market risk, it should bring down its debt to equity ratio. So these are some kind of inferences that we draw. I think I said in many courses that interpretation is basically means what the number is telling you, and inference is what the number has an impact on the company in the following years or the time to come. So what are the future consequences of the number upon the company? And the future consequence of this number is that there's a big gap between levered and unlevered beta. And if this company wants to reduce its exposure to the market risk, then it should definitely think about lowering its debt to equity ratio, which is quite high, 1.19. It's quite big. So there's more debt in the company than the equity it has. All right, so we carry on. We carry on this whole thing. And this task 6 is actually based on your levered and unlevered beta. So task 6 is based on levered and unlevered beta. So you would be having a company, one company, like I chose Microsoft. You can choose any company, and the company you choose can be same. Because in task 2, 3, 4, you choose more than one company, I guess. At least in task 2 and 3, you have a portfolio. So you don't have to calculate for the whole portfolio unlevered beta. Well, you can, but you don't have to. So what you can do is you can calculate, you can pick one company and do the whole analysis based on that one company. Okay, and then you can come up with this unlevered beta of that company. If you want to do for more than one company, why not do it? But one is enough from my side. So that is task 6, quite easy. And then the next example is again based on your financial leverage or the levered unlevered beta. Actually, I have a history about this task. 2 years ago, I was approached by a small local company, an IT company, basically. And its name was not Too Soft. This is a fictitious name I gave. And this company was actually thinking to measure its systematic risk. And they asked me that, Shab, how can we calculate the systematic risk of the company? And I said that, hey, you cannot, because you're such a small company. You're not listed in the stock exchange. You don't have the shares trading in any stock market in the world. So unless there is a stock trading, you cannot find the systematic risk exposure. But what you can do is that you can pick up your legend companies, Microsoft, Oracle, Adobe, because even though you are a tiny mini company in front of Microsoft or Oracle, but basically you are in the same industry. And what we do is that we can pick up a set of 15 legend company I picked up because it was a student's project. So my students also helped me a lot. And we picked up 15 companies. And those 15 companies, we did exactly this, we call it comparison analysis. So we did this comparison analysis based on this information. So what we did was I took the beta equity of all this. I am only taking 3 companies here, but I took 15 actually. So the levered beta or beta equity. And then we saw the debt equity. The question this company was basically trying to investigate, there were 2 questions they were investigating. First of all, they wanted to investigate that if this company, this startup, how much risk exposure it has. That is, the company was interested in knowing the beta coefficient. Secondly, because the startup company was heavily financed by debt, it was also interested to find its beta without debt. That what would be my unlevered beta? And thirdly, this company was interested to know that if this company has to invite some shareholders, outsiders in the company, if somebody wants to invest, if they have to do some pitching, if they have to make some demo, that why a bank or a big rich financer should invest its money in this company, what should be the minimum return they should promise to this investor, because the first thing investor would ask you that, hey, how much money I would get from this investment? So they want to know that what should be the return on equity, the minimum return on equity they should promise to the investor if they find some angel financier or anybody who's interested to give money to this company. So they have three questions. So their first question was that what is the systematic risk? What is the market risk they are exposed to? The big companies have an advantage that we can calculate their beta. Okay, so we can measure the systematic risk, but the small company have a problem that they cannot calculate the beta, but that doesn't mean that the market doesn't, they don't have the market risk. They have the market risk. In fact, they have more market risk than the big companies, but the only problem is that there is no way to measure their market risk in the normal literature. So then we use this comparison analysis. So what we did, we took this data as I showed to you, and then we calculated, we got some additional information that the risk-free rate is 4%. This is fictitious, it's not, 4% risk-free rate is nowhere in the world now, except at some small Panama or some strange place where things are not so regulated. The risk premium is 8.4. If you recall CAPM, in CAPM, I can quickly actually show you. I have explained it before, but anyways, I can do it again, no problem. If you look at the CAPM model, let me share the screen with you. Yeah. If you look at the CAPM model, you will see that the minimum return that you promise on equity is equal to risk-free rate plus beta times RM, that is the return on market. For example, in case of Microsoft, the example which I showed you some time ago, the NASDAQ, annualized NASDAQ return can be called as your return on the market portfolio minus risk-free rate, RF. This portion of the CAPM model, CAPM means capital asset pricing model. This portion of CAPM is called risk premium. Red part is known as risk premium. Risk premium means if I want to invest in your company, I will expect a certain minimum return, but I would also demand the compensation for the additional risk. So for example, if I want to invest in Prisma, I can be prepared to invest, let's say, 7%. But if Prisma is not a retail company, but it has some media or some IT solutions, and the risk is more, then I would demand some compensation for extra risk. That is called risk premium. So coming back to the question example, risk-free rate is 4%. This is just hypothetical. The risk premium is 8.4. So basically, 8.4% is RM minus RF in the CAPM model. CAPM holds, so we assume that capital asset pricing model is working fine. Debt is risk-free. There's no risk. There's no financial distress cost. And the firms which I took, I call them as legend companies. They are good comparisons. Okay. So for example, if this company which came to me was a media company or an IT company, and I took the legend companies as Walmart, Tesco, Finnair, then that, or GlaxoSmithKline, that would be a bad choice. because none of the legend company is in the IT sector, okay? So I must make sure that if I need to know what is the business of this company, which is asking for these questions, these three questions. And the legend companies are the leading companies in that field, okay? I repeat, the three questions which the company asked me was, number one, what is the beta to this company? How much is the systematic risk? Secondly, how much is the systematic risk without debt? That is, they're asking me, what is their unlevered beta? And third thing is that if they have to convince any investor, any shareholder in the company, what should be the minimum return? They should say that, hey, I'm sure you will get minimum this much return. Because when you do pitching, the first thing they would ask you that, hey, how much I'm gonna get from this investment? So, okay. And you can't just tell any random number. You have to tell them that you have done this calculation based on the capital asset pricing model or any other model for that matter. But CAPM is most widely used in this respect. All right, so there we go. And your task 7 is based on this, but of course, I'll explain this calculation first. All right. The first thing we do is we calculate the unlevered beta of Microsoft, Oracle, and Adobe. Remember, we have their levered betas already. We have the levered beta of Microsoft, Oracle, Adobe. For Microsoft, the levered beta is 0.75, Oracle 1, Adobe Systems 1.08. So we are now going to change these levered betas or equity betas to unlevered or asset beta, and that's what we do here. We apply the formula, the same formula which I did some time ago for Microsoft. The levered beta divided by 1 minus TC, because the corporate tax rate is 34%. So I already subtracted 1 minus 0.34 is 0.66. So basically, don't get confused with the same calculation which we did for Microsoft unlevered beta. And the same thing I do for Oracle. I didn't show it, but the value is this for the Adobe, and then the average unlevered beta for this company, TwoSoft, fictitious company, is 0.83, whereas the average levered beta is just the average. The third question was that how much minimum return they should guarantee to its investor. Again, this question depends on if you are debt financed, if you are a levered company or unlevered company. Look, when the company is levered, I apply CAPM, risk-free rate, plus beta. Which beta? Levered beta, because the company in the question is levered company. And then the market risk premium, which was 8.4%, mentioned here, this 8.4%, okay? And then we apply the normal CAPM model, and it comes to be 11.89. It means that now the company can say its investors that, hey, if our company has debt, then the minimum return which I would provide you is 11.89, because due to inclusion of debt, the market risk is more, and I want to compensate you for this additional marginal market risk. But if your company chooses, this software company, this startup company, if it chooses to remain an unlevered company, that is no debt, then we use same formula, risk-free rate, plus the beta this time is unlevered beta, and times the risk-free, the risk premium, and it comes out to be 10.97%. And now, when this company was pitching against its investors, it said that, hey, we will give you 10.97% return because, and this return is lower than 11.89 because in this new scenario, we have no debt, and there's no debt, there's less risk exposure, so we will give you less return. So you can see that the risk exposure is more with debt, and as a result, the cost of capital is also more. When the company is levered, the cost of capital is less. The cost of equity is less when the company is unlevered. So how much you are going to offer to your investor also depends upon if you are using unlevered beta or levered beta. That's why this concept is very important. The levered and unlevered beta is not just important that you want to do some what if analysis, but this also have an impact on your cost of equity, especially when you are a small company and you are going to raise some money from outside investors and you're making some demo, you're giving some pitching to attract them to your company. So you have a spreadsheet called FinAir Risk Return Comprehensive Analysis 20 years. And this spreadsheet is a comprehensive data analysis of FinAir. And this is an Optima. And you can see that I've done all this calculation with my comments, and you know that this is there. So there's no surprise. But yesterday I made some small addition to it. Yesterday I got interested to know that because I remember that we calculated beta of FinAir based on 20 years stock price. You can see the total sample size is 4645. So 4645 means approximately 18 to 19 years, I think, we took the data because some data was not available, and we found the beta to be 0.24, which is quite less. It's quite okay, no problem. And then we also got systematic risk, total systematic risk, total risk, and then we also found the minimum expected return by applying CAPM model, okay? And in the CAPM model, we found that the actual return of the company, the annualized, is 9.422%. So FinAir was generating 9.422% annually for about 19 years, whereas the expected return was 2.750 annually based on the 19 years data. So the Jensen alpha was positive. It means the company has marvelously met its minimum return. So that was great. But then I got interested yesterday that, hey, how much is the company's levered and unlevered beta? And then I took the data of FinAir's debt. Can you see it? Can you? Is it visible? Wait a second. Yeah. And then I took FinAir's debt and equity. And then the ratio I found debt to equity was scary. It was 1.88. So it's huge. 1.88 means for every €1 of equity, FinAir has 1.88 euros of debt. Okay. And then I took the data of profit before tax, which was 188.6 million euros, and then the tax the company pays is 37.9, and then the profit after tax, well, that was not important anyways, but I calculated the effective tax rate, which FinAir was paying, and it was about, if I can make it in the percentage form, it looks better in the percentage. Maybe 3 decimals. Yeah, so it was paying basically 20.095 percentage of tax, and this is not a headline or a Googled tax rate. It's an actual effective tax rate, and then based on that, I calculated the unlevered or the asset beta of FinAir, and it comes out to be 0.09. So you can see that with debt, the FinAir's beta was 0.24, which was less anyway. But when we have this hypothetical beta without debt at all, it becomes smaller, and it's almost zero. So I can say that if FinAir today has no debt, then its market risk is close to zero. Means no market risk, no market risk. And we have read in theory that there is always some market risk which remains. You can never get rid of the market risk. It definitely will be. If you remember the topic which I shared with you. Let me show you. So what it seems that Finnair's beta without debt. So hypothetically, if Finnair is without debt today, its beta is almost 0. Yeah, which is absolutely in contrast to the theory. Now, when I go to Optima back and I go to the lecture slides and I took at topic 1, which we have discussed. Let me make sure that you can see it here. And I remember one picture, I make a drawing on the board, and also it's here. Look at that. The market risk can never be 0. This is what the theory says. But when I see the when I see the market risk here for Finnair, potentially it can be 0 if Finnair chooses not to have any debt at all. Okay, but now one more thing we can do is that we calculated the Finnair's expected return. Now, Finnair's expected return is also basically, we applied the CAPM model here. Can you see CAPM model? RF, risk-free rate, plus U16, which is the beta. Yeah. So U21, the risk-free rate, is minus 0.30%. U16 is the levered beta, okay? And multiply by V12, which is the RM, the market risk, the market return portfolio, and minus U21, which is again the risk-free rate. And based on that, we find out that the minimum, the levered, so this is basically, I can also call it, this is also called, this is also called levered cost of capital. And this beta is also called levered beta or equity beta. And then we have the unlevered or asset beta. But can we also be interested in knowing that what if we have unlevered cost of equity? So we can also find unlevered cost of equity. So basically, if Finnair has no debt, what should be the minimum return it must promise to its investors? When Finnair has debt, the minimum return which it promises to its investors is 2.750%. And focus on U16. U16 is your levered beta. Now, I will use the same formula, except that instead of U16, I would use U35, which is unlevered beta, and see that if Finnair was absolutely debt-less company, how much it would have offered to its investors. So let's do it. So RF is same, plus beta, this time I use unlevered beta times bracket the market return, total risk, total return minus, once again, risk. So basically, this is 0.917%. Crazy, isn't it? It's almost the same return which you get by investing in Bank of Finland's security. Maybe a little bit more, but almost. So this is the, so if I can write a comment here, if Finnair was unlevered, unlevered company, it would have offered a minimum return on equity equal to less than 1% even. Just imagine, this is crazy. Finance is crazy. With debt, it's offering 2.750, and without debt, this is offering 2.1 and 0.917. So see the comments here. So you will see that what I'm trying to say. So as I said, this can be a fantastic topic for the further research, more advanced level with more companies, with inter-country comparison, and we can use this spreadsheet as a template. But basically, this is initially when I used this spreadsheet of Finnair was only to compare, only to calculate the beta, the levered beta, but then slowly things went further, and now we are able to find unlevered beta of Finnair, and at the same time we are able to calculate the levered cost of capital and unlevered cost of capital. So, and this is a change I have made right now in this spreadsheet. So after we hang up, I would upload this spreadsheet, this new spreadsheet with all these new calculations to the Optima. Okay. Well, that's basically everything from my side today. Thank you very much for your patience and everything. You've been wonderful as always. No surprise.